Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. We are in season number 2, and this is episode number 4 of the podcast series. The title of today's podcast is Looking Ahead to 2018. To begin with, let's quickly review 2017. 2017 was a good year for stock market investors. The stock market major indexes continually set records throughout the year. On top of the stock market performance, we had a year where bond yields and interest rates in general remained low. The Federal Reserve did raise interest rates 3 times in the calendar year, but yields and interest rates still remain near and close to historic lows. 2017 was also a year where we saw very little volatility in the stock market. So coupled with the terrific performance was very low volatility. And the last point in thinking about 2017 is the fact that the U.S. economy got on a strong upward trend, and we're in the midst of some economic growth that we haven't seen for a very long time. I'll touch on that in a few minutes, but I'll draw your attention to episode number 3 in season number 1, where I talked a lot about the economy. It was titled The Untold Economic Growth Story. Also, just before Christmas, I updated the topic and published an article with the same title, The Untold Economic Growth Story. You could get that article by visiting our website, www.elliottwealth.com. Elliott has 2 L's and 2 T's. Very, very good article. I think some great information. So 2017, good year for the stock market. Interest rates and bond yields remain low. Volatility was also low. And the backdrop was an fast improving U.S. economy. As we transition from 2017 and look ahead to 2018, we want to remember that even though 2017 was a strong year for investors, we ought to remain cautious and not become complacent. For 2018, our mantra is proceed with caution. It's a central theme of mine and the rest of the team here at Elliott Wealth Management Services. So, thinking about proceed with caution, I want to share with you 4 things that we're keying on in thinking about how 2018 might unfold. The 4 things are potential interest rate changes. Second is the effect of tax reform. Third is the potential return of stock market volatility. And fourth, we'll delve into a little bit more on the economic growth front. So the first is potential interest rate changes. I mentioned a moment ago, in 2017, the Federal Reserve raised interest rate 3 times. The expectations are for the Federal Reserve to raise interest rates another 2 to maybe 3 times in 2018. My opinion is that the market in general is likely to be able to absorb 2 to 3 more interest rate increases, especially if it seems like it's very deliberate and calm and there are no surprises. One of the worrisome things is if the Federal Reserve, in part because of concerns, believe it or not, concerns about the economic growth picking up steam, if they get a little jittery and they begin to raise interest rates faster than they've communicated thus far, and they go faster than the markets are expecting, that could be a problem, could create some significant headwinds in 2018. But even though that's a point of worry, the expectation that's generally throughout the markets is for 2 to 3 times in 2018. That's my expectation as well. And again, I think the markets could deal with that just fine, especially because of the improving U.S. economy. So that's the first thing. The second thing is tax reform. Right before Christmas 2017, the biggest overhaul in the tax code that we've seen in 31 years was passed into law. This tax reform is meant to lead to economic growth, improving job situation, and to create wage growth. So there is quite a bit of optimism about this helping the economy to grow at a faster rate than we saw the previous 8 years. Not everybody is on board, but I think in general, there's more optimism about this reform leading to economic growth. I think there's also a fair amount of optimism that it will help on the job picture. The job front in the United States has improved dramatically over the last 9 years. The unemployment rate is down to 4.1% now. The U.S. economy has created jobs for 87 months in a row, which is a record for the United States. So the jobs picture has already improved over the last 9 years. Will this tax reform help further improve the job market? That's something that we're watching closely. And related to the jobs picture is wage growth. For a very long time, one of the nagging problems in the U.S. economy is the fact that we have not seen wage growth. Corporations are doing okay with profitability. The federal government takes in lots and lots of money. Tax revenue-wise, there's a lot of positive things we could look at over the last 9 years in terms of the economy, with many of them picking up steam in 2017. But what has not occurred is wage growth. Wage growth in 2017 was around 2.5%. That's kind of been the norm over the last several years. I'm going back even before George W. Bush was president. But that's not enough. So will this tax reform lead to better wage growth? If it does, that'll be wonderful for the American worker and really terrific for the economy overall. There's a lot of uncertainty as to whether it will do that or not. There's some optimism, but there's an equal amount or maybe even more pessimism. And there's also a fair amount of, well, let's wait and see. But that's something we want to monitor very closely. Elliott Wealth Management Services, on the tax reform front, we will be issuing a tax report later this quarter. So look for that. If you're on our mailing list, you will receive it automatically. If you'd like to join our mailing list, go to www.elliottwealth.com and sign up for the mailing list. And I think that report will shed some more light and give you more insight into how we're thinking about tax reform and how it will affect our clients and how it will alter how we are thinking about the markets and our investment decisions. So the first thing was potential interest rate changes. The second thing is tax reform. Third is stock market volatility. As I mentioned earlier in this conversation, 2017 was a non-volatile year for the stock market. We expect volatility to return in 2018. We don't believe that this calm, consistent, deliberate, linear growth in the stock market will continue. 2018 may be a good year, maybe not, but either way, we think we'll see more volatility. We want to watch closely to see how a return of volatility will affect investors and change investor behavior. So that's something that we want to watch. And then the last of the four things is economic growth. I know I've mentioned this quite a bit in this conversation. It's been a central theme in our communication with clients for close to a year now. But I can't understate the importance of what's happening in the economy as it relates to how we're talking to clients, how we're positioning ourselves, and what their outlook is and what our outlook is moving forward, given that we're experiencing economic growth and economic improvement that we have not seen for a long time. So I referenced the Untold Economic Growth Story, but let me fill in a few of the blanks. Consumer confidence index is at a 17-year high. You have to go back to the waning days of President Clinton's administration. Yes, President Bill Clinton's administration, to get to a point when U.S. consumers were as confident as they are today. Said another way, U.S. consumers right now are more confident than they ever were under George W. Bush's administration, and consumers are more confident today than they ever were under President Obama's administration. And that's very powerful economic data point that bears watching and celebrating. I mentioned jobs. The job picture in the United States continues to improve. And on the gross domestic product, or GDP growth front, the average GDP growth under the 8 years coming out of the financial crisis during President Obama's administration was around 1.5%. As I'm recording this, the fourth quarter of 2017 has not gotten released yet, but here's how 2017 unfolded. Is in the first quarter, GDP growth was 1.4%. These are annualized numbers as they're reported by the Federal Reserve. So the first quarter was 1.4%, which is lousy. The second quarter, though, was 3%. The third quarter was 3.2%. The Federal Reserve has been estimating that the fourth quarter will be between 3.3 and 4%. So we are going to come in way ahead of 1.5% GDP growth for 2017. I think there's a good chance we'll actually double our previous 8-year average and get to 3%. But even if we fall short and end up somewhere in the 2.7, 2.8 range, that still is 30 to 50% higher than what we averaged over the last 8 years. If we do 3% in the fourth quarter or better, which seemingly everybody expects, that will mean that we had 3 consecutive quarters in a row where GDP growth was 3% or better. You would have to go back to 2005, almost 13 years ago, to get to the last time the U.S. economy grew by 3% plus for 3 consecutive quarters. And also, if in the fourth quarter we could do better than 3%, 3.2%, which is largely what is expected, we will also, if you could picture a trend line, we will have gone from 1.4 to 3, up to 3.2, up to 3.64, 3.5, something like that. So the economic growth is accelerating, which is also exciting lots of market watchers. I'll also add on the economic growth story is that Goldman Sachs research economists predict 4% GDP growth in 2018, which, as you might imagine, based on my commentary so far, is the type of GDP growth we have not seen in a very long time. We have yet to have a single year, well, let me say it this way. From 2009 through 2016, we did not have a single year of 3% plus GDP growth. So if we could get past 3% and then on our way to 4%, that will do wonders for the U.S. economy, I think, for workers in this country, and that should have a very positive effect on the markets, in my opinion. It's not just Goldman Sachs. J.P. Morgan Chase's Jamie Dimon, the CEO, often considered the best banker in the world. He's also on record sharing his thoughts that we might get to 4% GDP growth in 2014. This economic growth story, which is not talked about much in the media, and far too many of our politicians are going to talk about this, is really important, and it's something that we're going to watch very, very closely because it's going to affect not just how we position clients in thinking about their investments, it's also going to have an impact on our outlook. And not just our outlook, it should have an effect on how our clients and the people we're talking to are viewing their financial prospects and the direction of the country. So that is the outline of looking ahead to 2018. Again, our mantra is proceed with caution. We think we're going to proceed to a very good place, but we want to be cautious. We want to be watching these 4 issues and others very closely. So I appreciate you listening to the podcast. I would be very thankful if you would share this episode and other episodes with people you know, your friends, coworkers, family. That would be something that I would appreciate a ton.